the second session for accounts. We started with chapter 1 of financial statements of not-for-profit organizations. We talked about the definition, the features of such organizations, and what kind of financial statements we do prepare. We studied little bit about the features of receipts and payment account. We'll be starting with the format and what all comprises in the receipts and payment account. Before we do that, we'll be talking about 4 terms, and the terms are capital receipts, revenue receipts, capital expenditure, and revenue expenditure. You're all aware of them, but still we'll recap them again because we will be learning them with respect to this chapter. So when we talk of capital receipts, they are the receipts for which the purpose is specified by the donor. Who is a donor? Donor is a person who is donating money to an organization for the purpose the organization has opened for. And when we talk of not-for-profit organizations, we talk of motive, which is not profit, but it is service. So when the donor is specifying and saying that the amount he is donating to the organization is for a specific purpose, for example, if the donor is saying that the amount that he is donating is only for upliftment of women, you cannot use that donation, you cannot use that amount for any other work. Such case is an example of capital receipt. When we talk of revenue receipt, it's a receipt which is received as an income by the organization in carrying out the activities. Normally people do come and say this much we want to donate, and you can use this money wherever you want to. That comprises of revenue receipts. This is the format of receipts and payment account. Receipts and payment account is a real account, and the rule of real account is debit what comes in, credit what goes out. So debit side is going to be receipts, credit side is going to be payments. In debit side, we are going to record all the receipts irrespective of the accounting year that we discussed in the last session. So all the revenue receipts, all the capital receipts, whether they pertain to this year or previous year or next year, we are going to record it. And the revenue and the capital payments also we are going to record in such manner. When we open this account, the opening is done by the opening balance of cash and bank of that organization. If the bank is having a credit balance, then it will be by balance brought down bank overdraft, since it's a credit balance of the bank, right? So now we have some examples of revenue receipt with respect to not-for-profit organizations. And revenue receipts means these receipts can be used for the normal operations of the not-for-profit organization. If you've sold newspapers, if you've received interest on investment, if you have received any locker rent is received, general donations are received, all these things comprises of revenue receipt for the not-for-profit organization, and they are shown on the debit side of receipts and payment account. Let's move to the next slide. Capital receipts and revenue receipts. Capital receipts we did talk about and revenue receipts. In the previous slide we did talk about the revenue receipts. Now in the slide next we'll talk about the capital receipts for a not-for-profit organization. Life membership fees, donation for a specific purpose, we did talk about it. If we are selling any fixed asset, we are selling any investment, and or we are receiving any amount for a specific purpose or specific fund, all these will comprise of capital receipts. We'll be talking about the terms like legacies, endowment fund, life membership fees in detail in another session, maybe tomorrow. So let's just keep it simple here. Okay, now we'll move to the expenditure side. What is revenue expenditure? Revenue expenditure is an expenditure whose benefit expires within one accounting period. Okay, since receipt and payment account is a real account, we are going to show the revenue and the capital expenditure on the credit side of the account. So what are the revenue payments that the not-for-profit organization has to deal with: advertisement, telephone, entertainment, audit fees, repair, maintenance, insurance, rents, rates. So you can see all the revenue payments are mostly the examples of the expenses which we mostly show in the debit side of the profit and loss account, right? But these are then pertaining to the not for profit organization, so we'll have upkeep of the ground if it's a if the motive of the not for profit organization is to promote sports, if it's to promote culture, or if it's to promote any literary language, then definitely they'll be having their recurring expenses of their types. Okay, what's a capital expenditure? Capital expenditure is an expenditure whose benefit extends over one accounting period. What we can see here is examples like land, building, plant and machinery, where a big amount goes, and definitely the benefit extends over one accounting period. Okay, we'll quickly go through the difference between capital and revenue expenditure. This is a part of class 11, you've already done it. So capital expenditure is like if we have to acquire permanent assets, or if we even are adding value to existing asset, that is also capital expenditure. And what is revenue expenditure? Revenue expenditure is where we are we are doing a revenue expenditure of a routine type. Okay, it can be in the normal course of business. Capital expenditure increases the earning capacity. If you're buying a new plant, then definitely it is increasing the earning capacity. If you're repairing that plant, that is revenue expenditure. It is maintaining the earning capacity. Okay, capital expenditure is of non-recurring nature. Non-recurring nature means it does not reoccur again and again. And revenue expenditure is recurring. Salaries we have to pay, printing and stationery we have to again and again pay for it. Okay, capital expenditure is its benefit goes on for years and years, but in revenue, if we are doing any revenue expense, any recurring expense, the benefit expires within one accounting period. Let's go to our next slide where we'll be talking about some capital payments. Capital payments is where we are repaying a loan, where we are buying assets, where we are purchasing investment. When we are closing this account, we have to close this account by the balances of cash and bank. If it's a credit balance of bank, it will be shown on the debit side because it's closing, and then brought down will go to the credit side. So this is the way where we make the receipts and payment account. It's the first financial statement that we have discussed in detail with meaning, features, formats, and little bit of definitions to finish off. So I want that you should make the receipts and payment account in this format in your registers. So whatever was shown in parts will actually come together like this, where in the receipts side you will have opening balances, revenue receipts and capital receipts, and in the payment side you will have a credit balance of bank, revenue payments and capital payments. And you're supposed to make the format in this way, not in the way the slides are shown. The slides are made just to make you understand things. We want this clearly like this in your registers neatly. Okay, we'll be talking about income and expenditure account now. Income and expenditure account is a nominal account. So all of us know that the rule of nominal account is debit all expenses and losses, credit all income and gain. So actually when we maintain this account, debit side is going to be the expenditure and credit side is going to be the income. Okay, this account maintains itself on accrual basis of accounting. Accrual basis of accounting means it records only current accounting period items, whether paid or not, whether received or not. Okay, all the accrual concepts of prepaid, outstanding, received in advance, paid in advance are going to be taken into consideration when we talk about income and expenditure account. There is no opening balance of income and expenditure account. When we close this account, we get either surplus or deficit. And this surplus or deficit is transferred to the capital fund. Capital fund is actually shown in the balance sheet, which we will be discussing tomorrow, not in this lecture. When do we get surplus? We get surplus when income is more, expenditure is less. Income is shown on the credit side. So when credit side is more, debit side is less, balancing figure will come on the debit side. So surplus will be shown on the debit side of the account when we are balancing this ledger. When do we get deficit? We get deficit when expenses are more, income is less. When expenses are more means debit side is more. So balancing figure we go to the credit side, and deficit is shown on the credit side of the account by balancing and closing this account. So this account is not having any opening balance, and when we close this account we get surplus or deficit. Okay, now capital fund is shown in the liability side of the balance sheet. That's okay, we'll discuss this term later. Okay, when we talk of accrual basis of preparing income and expenditure account, I told you that it involves all adjustments relating to prepaid, outstanding provisions, accrued income, and whatever is received in advance. Okay. So revenue expenses for the accounting period are taken whether they're paid or not, because it's on accrual basis. Revenue receipts are also taken whether they are received or not. Non-cash expenses like depreciation are accounted in this account. Capital expenditure and capital receipts, they find no place in income and expenditure account because they will be taken care in the balance sheet. Okay children, we will be having this income and expenditure accounts format. So debit side will be having your revenue expenditures and revenue expenditures relating to the current year, and credit side will be having revenue income, and all this income will be taken care for the accounting period, one accounting period. If income is more, expenditure is less, surplus will come on the debit side. If expenses are more, income is less, deficit will come on the credit side. Either of the two will come. Either it will be a surplus or it will be a deficit for the not-for-profit organization. It's not net profit or net loss. They have surplus or deficit. Okay children, this is a small example, and this slide is very important when we will be attempting questions relating to income and expenditure account. Such questions are often asked for 3 to 4 markers in your CBSE board, wherein they just give you one expense like salary or one income like subscription, and they'll give you some items like what is outstanding in the end, advance in the beginning, and they would like to know what is the amount that will go in the income and expenditure account. Okay, so if the salaries amount is given, what are we going to add? Outstanding in the end. What is outstanding in the end? The whole accounting year has gone, still there is something that is outstanding. Okay, this will be added because this pertains to this current year. Whatever is outstanding is of the current year, and in income and expenditure account we have to take whatever pertains to current year, whether it is paid or not, received or not. If we have received anything in advance in the beginning, then definitely it relates to the current year. In starting only we got it, and the person is saying this is the advance. That means the advance is for the current year. So definitely that will be added to it. What is not of this current year? Anything which is outstanding in the beginning. The accounting has just started, and the organization is saying this much is outstanding. That means this outstanding does not pertain to the current year. It pertains to the previous year. So it will not be part of the income and expenditure account. So this amount will be subtracted. What else will be subtracted?